So hi guys, this is SJ speaking, and in today's video let's see about what is marginal cost of funds based lending rate, that is MCLR system. So this is also one of the banking videos. So before going to the video, I'm personally teaching trading. So if you want to join my mentorship course, you can contact me from the number which I've given on the scrolling below. I'm totally taking 7 courses. If you're interested, you can enroll in any one of the 7 courses. So now let's go into the video. So what is marginal cost of funds based lending rate, MCLR? So usually the banks lend to the customers. How the lending rates, the interest rate, the loan rates are calculated. How they give the loans to the customers, on what basis the interest rates are calculated. So that's why the banks refer to some benchmark rate. So known as MCLR. Previously, I have stated about base rate and BPLR video. I posted video regarding those two rates. So now let's see about MCLR. So internal benchmarking means the RBI gives guidelines only. Based upon the guidelines, in case of BPLR, the bank gives some guidelines and the banks used to calculate their own BPLR rates. And in case of base rate and MCLR, the bank gives the guidelines but also calculates base rate or MCLR rate, which is used as reference by the banks to calculate their own base rates or MCLR rates, and then they had a spread to the base rate and MCLR rate in order to calculate the final lending rates. But now the base rate system is replaced by the MCLR system. So now let's see the definition. So MCLR system is an internal benchmark lending rate which acts as a reference rate to the commercial banks to calculate their own MCLR rates, which is used to calculate the final lending rate to the customers. So MCLR is the minimum lending rate below which the banks are not allowed to lend to the customers. So similarly as the base rate below the MCLR, suppose if the MCLR rate is 8% means, so this is the RBI's MCLR rate. Bank's MCLR rate might differ, 8.2, 8.3 like that. But this is the RBI's lending rate. Below this 8%, the banks are not allowed to lend with some exceptions. But with some exceptions only, but mostly they are not allowed to lend to its normal customers. Then MCLR was introduced by the Reserve Bank of India in 2016 after replacing the base rate system, and eventually the MCLR system was also replaced by the external benchmark lending rate system EBLR in 2019. Why? Because the MCLR also had some drawbacks. But why the MCLR was brought by replacing the base rate system? The drawback in the base rate system is because the RBI gives loan to the banks, commercial banks, and the banks give loan to the customers. If the repo rate decreases, then the lending rate to the customers must also decrease. If the repo rate increases, the lending rate to the customer increases. So if repo rate increases, then the base rate must increase. This is okay, fair. If the repo rate reduces, then the base rate must reduce. But what the banks did, if the repo rate reduces, the base rate, they kept it unchanged. So this was unfair to the customers. So RBI asked the banks why they have not changed the base rates. They gave an argument that their cost of funds was high. That is, the deposit rate was fixed. So suppose, give me an let me give you an example. For example, if the repo rate is 7% and I am giving FD rates on 6% to a specific customer, so this is unchanged. Even if the repo rate changes to 5%, this is unchanged because this is fixed. So I can't reduce the base rate. So since my cost of fund is high, this is what the banks argued. So what the RBI did, it brought a new change. It brought the MCLR rate, that is marginal cost of funds based lending rate. Usually in case of base rates and other rates, the cost of funds are calculated average. So average cost of funds is used for was used for calculation. But now here marginal cost of funds is used instead of average cost of funds. So what is the, so how MCLR is calculated is marginal cost of funds, operating cost, negative carry on CRR, tenure premium. So what is this marginal cost of funds? So it is the incremental change in cost of funds for additional borrowings done lately. So recently the banks would have borrowed some funds lately. So that alone is taken. So the cost of funds for the latest borrowings alone is taken. So you can also say it as latest change in cost of funds. So that alone is taken. So latest deposit rates are taken. If the latest deposit rates are taken, the deposit rate usually would be lower if the repo rate decreased. If the repo rate had increased, the deposit rate would be higher. Suppose if the repo rate decreased means the latest deposit rates would be lower. So that rate alone is taken. That interest expenses alone taken. The latest rates are alone taken for calculation. So that is what marginal cost of funds. So incremental change in cost, the latest additional cost alone is taken. So for example, let me say, if I am borrowing 100 rupees at an interest rate of 10%, again I am borrowing 100% at 20% rate of interest. Again I am borrowing 200 rupees at 25% of interest. So these things, take this two first two things. So in this case, if the calculation is, so since the values are same, we can directly add this value 30% divided by 2. It gives 15%. But suppose that if the value is different, means the actual calculation must be like this. So 30 would come the answer. This 30 divided by the total number of rupees, that is 100 plus 100, 200 into 100. So divides 2, then answer comes 15. This is the actual calculation. But since here the loan amount is same, so that's why we can directly add the interest percentage and divide it by 2. In case of, so this 15% is for 200 rupees. Then again we take this 25% of this to the 200 rupees. Since the loan amount is same, we can add it directly, 40% divided by 2. So answer is 20%. So 40% divided by 2, 20%. So this is the average cost of fund. This is the new average cost of fund. This is the old average cost of fund. Old average cost of fund, new average cost of fund. So basically, if you are calculating using average cost of fund, your value would be, your cost of fund would be 20%. But if you are using marginal cost of fund, you have to find the difference between the new and the old average cost of fund. The current cost of fund minus the previous cost of fund, the difference. So incremental change, that is only 5%. So 15% and 20%, the difference is only 5%. So this 5% is known as your marginal cost of fund. So if you are taking average cost of funds means 20%, but marginal cost of funds means only the difference between the old and the new average cost of fund, that is 5%. So the cost of fund actually decreasing in this case. So which is good for the customers, which is fair for the customers. The banks are also not get affected. They are also getting a fair value. And this is what the RBI did. So before that, let me say difference between rules and guidelines. So rules means definitely you have to follow it, but guidelines means, so RBI gives a guideline means it is given for your good, for your it is RBI ensures fairness for the customer as well as for the bank. So it is both good for the customer as well as the bank. So RBI gives some guidelines. If you follow this, you would be all right. So, but it is your decision whether you can follow it or not. That is why the guidelines. So internal benchmarking means guidelines. Guidelines only is given, not the rules. So in case of marginal cost of funds, so the first component only we are seeing. So marginal cost of fund, 100% is taken by the marginal cost of borrowings, which I have explained now. So borrowings from the customers, the bank will borrow from the customers, from the corporates, and from the RBI. So deposit rates or some other rates, it borrows. So this is the marginal cost of borrowings. And another 8% weightage is given for the provisions. Provisions means, suppose you are giving loan to some customers. There is a risk of default. If he doesn't repay the loan, repay the principal amount, in order to compensate the risk, some amount has to be in the bank itself in the form of cash as reserve. So provisions, that is what provisions. For this, there is no interest rate earning because it is simply in the bank. If we are invested it somewhere else, we would have got some interest. So that is also taken into account in the cost of funds. We get that money from the customers. So that is also included. This is the first component. So together constitute the MCOF, that is the marginal cost of funds. Next comes the operating cost. That is the rent cost, the electricity bills, and the employees to the customers. Then comes the negative carry on CLR, sometimes SLR also. But CRR means, I have posted a separate video regarding CRR and SLR. You can watch that. But SLR means some of the amount has to be placed as reserves in the RBA. For example, 5% means from our NDTL, 5% has to be kept as reserves in the RBA, and the RBA doesn't pay any interest to this amount. So what is this? Since the RBI does not pay interest, it is simply waste for the bank. If the bank had invested this money somewhere else, they would have gotten from interest. So this is the negative carry. Suppose if 10,000 is someone depositing and 5% you have to give him interest, means you have to pay him back 10,500. But 5% has to be kept as reserves in the RBI. So 9,500 only you are having. From this 9,500, you have to earn this 10,500, and we have to repay back to him along with our profit. If we are planning to earn around 11,000 means we have to lend this 9,500 at some higher interest rate, for example 8%. So that cost is also included in this MCLR calculation. That is the negative carry. SLR is mostly not included since most of the money is kept as reserves in our own bank itself in the form of government securities and gold. But suppose if we are keeping as reserves in cash means, so that is also included in this MCLR calculations. Next comes the tenure premium. Tenure premium means as the length of the loan increases, the risk also increases. So that account is also, in order to compensate the risk, some premium is charged to the customer. So that is also taken into MCLR. So totally MCLR is calculated. So first the RBI calculates the MCLR rate for the whole banking sector. Usually all the banks submit their data, submit the marginal cost of funds, operating cost of funds and all these data, and banks takes an average for all these values and it calculates an MCLR rate. So this is used as a reference by the bank to calculate their own MCLR rate, own bank's MCLR rate. So that MCLR is added along with the spread. So this spread takes into account the profit margin. This is the actual profit that the banks want to earn, and then the risk profile of the customer. So in the case of tenure premium, the risk is charged based upon the tenure of the loan. But here it is based upon the type of job that the person is, type of customer. Suppose if he is a business owner means, then higher interest rate is charged since he is having higher risk. The business owner might have a loss too in the upcoming year. He may make a profit or loss. But in case of a government employee means, usually salary comes to him per month, and so he is less risk. So this is taken, the profit margin and the risk profile is taken. So if the MCLR rate of the bank is 8.5 means, then the spread is 3% means, then 11.5 is the lending rate to the customer. So below this rate, the banks can't lend. So suppose this is the bank's MCLR means RBI's MCLR rate would be 8.2 or something. Usually below this 8.2, no one can lend. So that is the case. But banks also have their own MCLR rates. So this is the fact. So usually MCLR will be for overnight it will be, and for 1 month, 3 month, 6 months, 1 year, 3 year it will be. You can visit the websites of the specific banks and see. And another thing, still you can, if you are buying a loan, you can buy on the base rate as well as MCLR rate. Of course the bank asks everyone to transfer to EBLR, but everyone are still using this BPLR base rate and MCLR. Still you can watch the update in the values of the BPLR base rate and MCLR. But banks want everyone to change to external benchmarking. So MCLR, why it was replaced by this EBLR means, the MCLR usually the bi-monthly policy has to bi-monthly. If the repo rate changes bi-monthly means, the MCLR rates must also change accordingly to the repo rate changes. So bi-monthly, the MCLR must also be revised by the banks. For 2 months, the banks has to revise. But usually the banks change the MCLR rates for 6 months or 1 year only. So the customers are unfairly charged on the interest rates. So that's why the bank replaced this MCLR and brought the EBLR, external benchmark lending rate, which I'll explain in the next video. So hope you guys got a good clarification. What is MCLR and what are the drawbacks of base rate, and why the MCLR was replaced why the base rate was replaced by MCLR. So hope you got a good clarification. So if you enjoyed the video, give a thumbs up, share it with your friends and family, and subscribe to my channel, and also press the bell icon so you get notified for all my upcoming videos. And other than that, comment on my video. It would be a feedback and motivation for me. So other than that, so if you want to join my trading course, you can call me from the number below. So I'm totally taking 7 courses. It will be useful for you guys. And if you want to open a trading and demat account, I've given you Zerodha and Alice Blue link on the video descriptions below. And apart from that, I'm also having another channel, SJ's Trading School Tamil. So if you want to listen to my videos on Tamil language, you can watch that channel. So my channel is not only for trading and investing, it is also for finance related, commerce, economics, banking related. So if you are writing any banking exams or preparing for any bank exams, or if you want to pursue a career in finance field, my videos would be useful for you. So thank you guys. I'll visit you on my next video. Until then, bye bye. Take care.